So, if you look at the darling of the fast casual restaurant world over the last decade.
Oh, yeah.
I mean, the image that usually comes to mind is just this unstoppable engine, right?
Right, totally. Like a high-speed train.
Exactly. Just laying down track at this breakneck pace. They're picking up speed, they're adding locations, and, commanding immense pricing power with lines constantly out the door.
Yep. The lines are basically iconic at this point.
Right. But sifting through this latest Q4 2025 earnings call from Chipotle, I mean, the audio sounds a bit different.
Good.
The wheels are, they're screeching a bit. The track seems to be kind of warping under the weight of the train.
Yeah.
So welcome to this Talk Tickers Deep Dive.
Glad to be here.
Today, we are entirely bypassing the PR spin and the, sanitized corporate summaries. We want to get straight to the underlying data.
Exactly. Getting into the actual numbers.
Right, because our mandate today is to dissect Chipotle's Q4 results and basically translate all that heavy Wall Street jargon into actionable mechanics.
And figure out what the actual play is for anyone who's holding or, just eyeing CMG stock.
Exactly. And as always with Talk Tickers, we promise to give you this plain language translation, the hard data, and an actionable, opinionated take on what to do with the stock, all in under 5 minutes.
It's a tight window, but we've got a lot of ground to cover.
We really do. So let's set the stakes right away. Chipotle has historically wielded untouchable pricing power.
Oh, absolutely untouchable.
Right. But looking at these fourth quarter numbers, I mean, the core question driving this entire deep dive, are we finally watching the consumer hit a hard breaking point on premium burrito prices?
Yeah. Is the $15 bowl finally meeting market resistance?
Exactly. Because reading the commentary from CEO Scott Boatwright and CFO Adam Reimer, they keep deploying this specific phrase. They keep saying, quote, dynamic consumer backdrop.
Right. The dynamic consumer backdrop.
Which, I mean, in corporate speak, that translates to a stressed, value-conscious customer who is aggressively pulling back on discretionary restaurant spending, right?
That's exactly what that means. And that's why the central tension in this quarter's data is so fascinating.
Oh, totally.
Because there's this stark divergence between their top-line expansion and the underlying reality of the consumer market.
Right.
Management is essentially trying to engineer a soft landing for a consumer base that is showing severe signs of fatigue. And they are using their massive balance sheet as a shock absorber.
Which forces us to look really closely at the headline numbers. Because honestly, they paint a highly contradictory picture.
They really do. I mean, on one hand, you have Q4 revenue hitting an all-time high of $3 billion.
$3 billion.
Yeah, $3 billion, which is a 4.9% increase year over year.
Right.
So on the surface, that looks like a milestone quarter, right?
It sounds incredible. But then, you look at Q4 comparable restaurant sales. The comps.
Late comps.
And they actually declined by 2.5%.
Which is a huge red flag.
It's huge. And adjusted earnings per share came in at 25 cents for the quarter, which is just totally flat year over year, even though the full year 2025 EPS managed a 4.5% growth to $1.17.
Yeah. And then there's the most alarming metric for the institutional crowd.
Right, the margins.
Exactly. Restaurant level margins dropped 140 basis points down to 23.4%.
I mean, this earnings report looks like a burrito that's huge on the outside, but you bite into it and it's mostly just stuffed with rice.
Huh, that's a perfect way to put it.
Right, like you unwrap this massive $3 billion revenue number, but the actual meat, the same store sales and the profit margins is just missing.
Yeah, it's missing entirely.
So how are they growing the top line revenue by nearly 5% when the established core stores are actively losing ground? I mean, are we essentially just looking at a real estate expansion that's masking a restaurant decline?
Basically, yes. The revenue bump is almost entirely a mathematical byproduct of sheer footprint expansion.
Just opening new stores.
Exactly. They opened 132 new restaurants in the fourth quarter alone.
Wow. And over the entire year, they opened a record 334 new company-owned locations.
That's a lot of real estate.
It is. It pushed them past the 4,000 restaurant mark globally. So look at it this way. When you inject that many new cash registers into the system, total revenue scales up automatically.
Right. The math just does the work for you.
Exactly. But that 2.5% decline in comps, that metric strips out all the noise of those grand openings.
Because it only looks at stores that have been open for over a year, right?
Exactly. It isolates those neighborhood locations that have been operating for at least 12 months. They form the bedrock of the company's cash flow.
And those stores are hurting.
Right. The data shows fewer transactions or smaller ticket sizes at those core locations.
So the foundation is getting noticeably softer while the footprint gets wider.
Precisely.
And that 140 basis point drop in restaurant level margins, I mean, that is brutal in an industry where operational leverage is basically everything.
Well, it's painful, dropping down to 23.4%. Right. But, digging into the 10K, I noticed that margin drop is actually cloaked by an accounting maneuver.
Yes, the true up.
Yeah. They recognized a $27 million, quote, true up following their annual gift card breakage analysis.
That true up is a critical piece of the puzzle. For those listening, gift card breakage basically represents the liability of unredeemed gift cards transitioning into recognized revenue.
Right, like when someone loses a gift card in their couch cushions and never spends it.
Exactly. After a certain statistical probability of non-use is met, they can claim it as revenue. And recognizing that $27 million in pure profit boosted their Q4 margin by 70 basis points.
Wait, really? 70 basis points just from forgotten gift cards.
Yep.
So meaning, if we strip out the forgotten holiday gift cards from a few years ago, the underlying operational margin drop wouldn't have been 140 basis points. It would have been 210 basis points.
Exactly. They are bleeding profitability at the unit level.
Wow.
The cost of goods sold, labor, and operating expenses are just chewing through the cash flow of the core burritos.
Which leads to the obvious next question, right? Like, if top-line revenue is an illusion built on new real estate, what is actually driving this margin compression in the established stores?
Well, the primary driver is a deliberate strategic dislocation between inflation and menu pricing.
Okay, unpack that for us.
So CFO Adam Reimer outlined that Q1 inflation is running hot. It's approaching the mid-single-digit range of around 4%.
Right.
And this inflationary pressure is heavily concentrated in their core commodities like beef, avocados, and cooking oil.
But they aren't raising prices to match it.
No, they aren't. Management has deliberately capped their Q1 menu price increases at a mere 70 basis points.
That is wild. Q1 costs are up 4%, and they are intentionally raising prices by only 0.7%.
Exactly.
And, layered on top of that self-inflicted margin squeeze, they also cited weather impacts.
Right, storm Fern.
Right. They claimed a massive winter storm, Fern, caused widespread closures and instantly knocked 100 basis points off their Q1 comps.
Which is a significant hit.
It is, but add in the tapped out consumer and they're presenting a narrative of a perfect storm. But I have to say, I have a hard time buying the weather excuse.
You're skeptical.
Totally. Every CEO loves to blame the weather when numbers slip. It's like the oldest deflection in the corporate playbook.
Right.
Are we really supposed to believe a snowstorm and a deliberate choice to eat inflation costs are the whole story? Or is the core customer just tapped out?
I get the skepticism. The weather excuse is notoriously overused on these calls.
Right.
But the mechanics of perishable demand in the fast casual sector actually validate the claim in this specific instance.
Perishable demand. Okay, explain that.
So unlike durable goods retail, where, a customer might delay buying a television by a week because of a blizzard restaurant, demand perishes instantly.
Oh, I see.
Yeah. A customer who skips a burrito on Tuesday because the store is closed by snow doesn't buy 2 burritos on Wednesday to make up for the caloric deficit.
Right, unless they're really hungry. Yeah, that makes sense.
Exactly. That transaction is permanently lost. And given the sheer geographic scale of storm Fern across their most dense North American markets, a 100 basis point drag on quarterly comps is actually a statistically sound assessment of the lost operating days.
Okay, fair enough. I'll accept the mechanics of the perishable demand loss. But the inflation gap, that requires a deeper look for me.
Sure.
Because why would a company that has historically flexed immense pricing power, they've always been able to raise prices, why would they voluntarily choose to eat a 330 basis point spread between their input costs and their menu prices?
Because they recognize the broader macroeconomic exhaustion of the fast food consumer.
The consumer is just done.
Exactly. The industry at large has relentlessly hiked prices over the last 3 years to protect unit economics, and that's led to immense pushback. People are fed up with $18 combo meals.
Oh, for sure.
So Chipotle's internal research clearly indicates that pushing another 4% price increase right now, just to protect the Q1 margin, would cross a psychological threshold.
It would just break the customer's loyalty entirely.
Right. It would trigger permanent customer attrition. They are intentionally squeezing their own margins right now. They're underpricing inflation to play a long game for market share.
Wow. So it operates almost like a massive loss leader strategy, but applied to their core menu.
That's a great way to think about it.
They are just absorbing the financial pain to manufacture a perception of supreme value.
Exactly. While competing chains are forced to keep raising prices to, service their debt or appease angry franchisees, Chipotle wants the consumer to look at their menu and realize the price of a chicken bowl has remained relatively static.
So they are basically buying customer retention with their own profit margins.
Precisely. They're sacrificing short-term yield to build a structural moat around their market share.
That is a bold move.
It is. Management plans to cap price hikes at 1 to 2% for the full year of 2026, while they're projecting costs to rise 3 to 4%.
So the squeeze continues all year.
It does. And this strategy creates severe short-term turbulence. The gap between input costs and customer pricing is at its absolute widest point right now, meaning the upcoming Q1 margin print is going to reflect that maximum compression.
It's going to look really ugly.
Extremely ugly.
And, their exposure to specific commodity volatility just makes this gamble incredibly risky, doesn't it?
Yeah.
Beef and avocados are perpetual pain points in these earnings calls.
Oh, always.
Every quarter, it seems like their entire operating margin hinges on the avocado harvest in Mexico.
Yeah, that volatility is the direct cost of their, quote, food with integrity mandate.
Right.
Because they operate outside the highly subsidized, industrialized commodity markets. Responsibly raised, hormone-free beef relies on a much smaller, fragmented supply chain.
And that supply chain just lacks the scale to absorb sudden macroeconomic shocks.
Exactly. When feed prices spike or herds cull, Chipotle feels the impact immediately. They don't have the buffer that a traditional chain-sourcing standard industrial beef might have.
Right. And the CFO specifically called out the impact of trade policy on those margins, too.
He did, yes.
He noted that tariffs impacted the quarter by about 30 basis points. Though with the recent removal of tariffs on beef and agricultural goods, they expect that ongoing drag to drop to around 15 basis points.
Which is helpful, but still a factor.
But it's crazy. We are seeing geopolitical trade negotiations instantly translating into the unit economics of a side of guacamole.
It's the reality of their model. Operating over 4,000 fresh food restaurants means your P&L is violently exposed to macro-level supply chain disruptions.
Because they can't just freeze it all.
Right. When you refuse to freeze your ingredients or source lower-tier commodities, you lose the ability to hedge costs effectively over long durations.
So if management is actively choosing to absorb this margin pain to protect the brand's value proposition, their forward guidance becomes the critical metric, right? Like, we need to know when or if this strategy is supposed to yield a return.
Absolutely. And the 2026 guidance is a heavy dose of reality.
Oh, yeah. They are forecasting, quote, about flat, full-year comparable restaurant sales.
Yeah. Projecting flat comps for a full 12-month cycle is a stark admission for a stock that has commanded a hypergrowth multiple for years.
Right. It confirms that 2026 is officially and structurally a transition year.
Exactly. Management categorized this as a conservative baseline given the unpredictable consumer environment, but it effectively signals that they do not expect the established asset base to generate organic volume growth this year.
But they are aggressively deploying capital to change the operational mechanics inside those stores.
They are.
CEO Scott Boatwright laid out this recipe for growth, and the operational pillar focuses heavily on a new high-efficiency equipment package rolling out to 2,000 stores by year-end.
Which is a massive undertaking.
It really is. And they estimate this equipment saves 2 to 3 hours of prep time daily, improves throughput, and actually yields a juicier protein product.
This is a vital capital expenditure, because in a high-volume, fast-casual environment, peak hour throughput dictates your ceiling on daily revenue.
So how fast the line moves is literally how much money you can make.
Exactly. If your grill staff is bogged down with manual prep work that can be automated by high-efficiency equipment, they cannot focus on keeping the main line stocked during that critical 12 p.m. to 1:30 p.m. lunch rush.
Right, the rush is everything.
So eliminating 2 to 3 hours of prep time reallocates that labor to active food production and customer service when the store is at maximum capacity.
It solves the bottleneck where the line just halts because they're waiting on chicken to finish on the grill.
Precisely.
And Boatwright noted that in the 350 restaurants currently utilizing this equipment, they are seeing hundreds of basis points of improvement in comp sales.
Which is huge.
It makes perfect sense mechanically, right? If the line moves faster, you reduce the abandonment rate of customers who walk in, see a massive queue, and just turn around and leave.
Right. The throughput optimization directly correlates to capturing latent demand, but, the menu innovation pillar is where their strategy pivots aggressively.
Oh, this is the most fascinating shift in the entire report for me.
It really is.
Because they are leaning heavily into value and health trends with this whole new protein menu. They introduced a single Paco for $3.50 and a standalone cup of protein for $3.80.
Right.
And management noted that extra protein incidence is already up 35%. But, and this is where I push back, a $3.80 cup of meat sounds less like menu innovation and more like a desperate attempt to cater to the GLP-1 weight loss crowd.
The Ozempic demographic.
Exactly. The Ozempic and Wegovy users who physically cannot process a massive 1,200-calorie burrito anymore, but doesn't heavily marketing a $3.50 taco severely run the risk of cannibalizing their highly profitable $15 bowl orders.
That cannibalization threat is always the primary concern when a premium brand introduces a low-ticket item.
Right. You don't want people trading down.
Exactly. It risks training the consumer to spend less. However, the data management provided regarding check size augmentation directly counters that fear.
Okay, what does the data show?
Well, the CEO highlighted that 60% of Chipotle's core users have a household income exceeding $100,000.
Wow, 60%.
Yeah. This demographic is not utilizing a $3.80 protein cup as a meal replacement to save money.
So the data indicates these are pure add-on sale.
Exactly. Instead of a customer attempting to, game the line worker into giving a slightly heavier scoop of chicken for their bowl.
We've all tried to do that.
Right. But now they are formally ordering the $3.80 cup of protein on the side to hit their daily macro goals. It standardizes the double meat transaction and drives up the overall ticket size.
Okay, that makes sense. It acts as a highly profitable margin enhancer.
Precisely. The 35% spike in extra protein incidence proves the demographic is using these items to augment their existing orders, not to shrink their spend.
Got it.
And regarding the GLP-1 demographic, providing a high-protein, low-volume option is a defensive necessity at this point.
You have to offer it.
Yeah. If you do not offer a macro-optimized vessel for a customer whose appetite is chemically suppressed, they will just exit your ecosystem entirely. The protein cup retains that specific consumer within the brand.
They are also ramping up the frequency of limited-time offers, planning 4 LTOs this year, kicking off with the highly requested chicken al pastor.
A fan favorite.
Yeah, and they stated it generated double the requests and triple the social media demand of any previous LTO.
LTOs function as a transaction catalyst. They inject urgency into the consumer cycle to drive foot traffic.
Get people in the door right now.
Exactly. But the critical metric the CEO shared is that guests acquired through an LTO demonstrate a higher lifetime value.
Oh, really?
Yeah. They increase their visit frequency and annual spend long after the LTO cycle's off the menu.
That's fascinating.
So the margin hit taken to market, the LTO acts as an acquisition cost that yields a sustained return.
So smart. The final component of this growth recipe is their geographic expansion, which, looking at the call, presents a massive dichotomy.
It really does.
Because they are pushing hard into the Middle East, specifically targeting Dubai with their franchise partner Al Shaya Group, and projecting to double their footprint there in 2026.
Right.
But simultaneously, they are targeting 350 new company-owned locations in North America.
The international strategy reveals the limits of their operating model, to be honest.
How so?
Well, the franchise model in the Middle East is executing flawlessly, as evidenced by the massive grand openings and localized demand there.
Right.
But when pressed on European expansion, particularly France, the CEO was remarkably blunt about the structural difficulties. He cited wage inflation and prohibitive occupancy costs.
It totally exposes the friction of dropping a labor-intensive fresh food operating model into a region with strict labor laws and very distinct real estate dynamics.
Exactly. The unit economics simply do not translate the same way they do in North America or under a capitalized franchise partner in Dubai.
Which explains why the bulk of the growth engine still relies heavily on those 350 new North American stores.
Right. And that brings the narrative full circle. The 350 new domestic locations will ensure the top-line revenue continues to compound,
effectively masking the flat comps expected from the transition year. Which brings us to the actionable bottom line for you, the retail investor. We have dissected the top-line illusion, the margin compression, the deliberate inflation absorption, and the operational turnaround plan.
We've covered a lot.
We really have. So how do we translate this data into a portfolio strategy?
Well, the setup here is decidedly short-term bearish, but structurally long-term bullish.
Okay, explain that.
2026 is officially a reset year, a transition year. Management is consciously depressing their own margins to defend market share. So for an investor looking for immediate capital appreciation, this earnings print is a minefield.
Yeah, a total minefield.
The explicit warning regarding peak margin compression in Q1 basically guarantees that the upcoming earnings report will look fundamentally ugly on paper.
Which will likely exert downward pressure on the stock price.
Exactly.
So if you are currently holding CMG, you are essentially walking into that minefield over the next few months. You have to brace for a rough Q1 print where the 4% commodity inflation violently collides with their 0.7% menu price cap.
The market algorithms will react to that margin deterioration. It's inevitable.
Right. But for those looking to initiate a position, this implies that patience is the key optimal strategy. You want to wait for that Q1 or Q2 margin squeeze to fully materialize and depress the valuation, right?
Precisely, because the underlying financial architecture of the company remains untouched.
The balance sheet is the ultimate safety net here.
Oh, it's bulletproof. They closed the quarter with $1.3 billion in cash and investments and absolutely zero debt.
Hearing zero debt in this prolonged elevated interest rate environment is a massive structural advantage.
It dictates their entire capital allocation strategy. Because they are not servicing debt, they are aggressively deploying free cash flow into share buybacks.
Right.
They executed $2.4 billion in buybacks in 2025, and the board just authorized an additional $1.3 billion.
That is massive.
It is. Share buybacks act like slicing a pizza into fewer, larger pieces. By reducing the total number of outstanding shares, the underlying earnings per share mathematically increases for the remaining investors.
It basically installs a floor under the equity pricing during this whole transition phase.
Exactly.
And it projects extreme confidence from management. I mean, they are heavily signaling that they believe their long-term algorithm, which is reaching $4 million in average unit volumes with 30% restaurant-level margins, they act like it's a mathematical certainty once commodity inflation normalizes.
They certainly project that confidence.
But we have to view that critically, right?
Yeah.
Management teams constantly use future algorithms to distract from current operational fires.
Oh, absolutely.
So is this long-term projection a legitimate target, or is trusting this long-term algorithm just a classic Wall Street trap for retail investors to hold the bag while margins languish at a multi-year low of 23.4%?
It's a fair question, but distinguishing between a company just hoping for a macroeconomic miracle and a company engineering a structural turnaround really comes down to leverage.
Leverage, okay.
Yeah. A highly leveraged company promising future margin expansion is typically a value trap. But a company generating massive free cash flow, holding zero debt, and actively retiring billions in equity, they can afford to endure a flat year to rebuild their consumer base.
They have the war chest for it.
They do. They are weaponizing their balance sheet against their highly leveraged competitors. While standard fast food chains are forced to escalate prices just to service their debt, Chipotle can hold the line.
They can just absorb the inflation.
Exactly. And inevitably, they'll capture the market share of the exhausted consumer.
They are basically starving out the competition by outlasting them on value perception.
Exactly.
So the entire thesis hinges on whether this aggressive gamble on customer loyalty actually pays out in the back half of 2026.
That is the ultimate test.
Will the suppressed pricing and the rollout of the high-protein menu drive enough foot traffic to offset the margin pain they are enduring right now?
That is the definitive metric to monitor moving forward. The success of the transition year rests entirely on transaction volume rebounding as the inflation gap narrows in the third and fourth quarters.
Wow. Okay, as we wrap this deep dive, there's a broader industry implication I want to leave you with, something to chew on.
Yeah, let's hear it.
Look closely at this pivot toward the $3.50 taco and the $3.80 high-protein cup. Look at the aggressive marketing targeted at the clean eating, macro counting, GLP-1 demographic.
Right.
A demographic where, as we said, 60% of the users command a six-figure household income. We constantly frame Chipotle as a competitor taking market share away from traditional fast food. But are they even operating in that arena anymore?
It really suggests a fundamental repositioning of the brand identity.
Exactly. If the primary growth vector is optimizing protein intake for a health-conscious demographic, their actual future competition isn't the legacy drive-thru.
No, it's not.
They are positioning themselves against the local health food startup, the Sweet Green, the Kava, and the premium hot bars at places like Erewhon or Whole Foods.
which completely shifts the paradigm.
It does. If Chipotle successfully completes this transition from a high-volume burrito purveyor to a ubiquitous lifestyle wellness brand, the ceiling for their market valuation requires a completely different framework than we have historically used.
That's a fascinating perspective.
The track isn't warping, they are intentionally redirecting it toward a vastly more lucrative destination. So keep a close watch on those Q1 margins, monitor the transaction volume on the protein menu, and we will see you on the next deep dive.